Welcome to the Future Ventures podcast. Today, we're joined by Mike Solow. Mike is the co-founder of 99 Proof, a boutique investment firm focused on backing and scaling emerging beverage alcohol brands. With over 2 decades of experience across business development, sales leadership, and capital strategy, Mike operates at the intersection of operators and investors, helping founders not just raise capital, but deploy it in ways that actually drive growth. At 99 Proof, he and his team invest across equity, debt, and real asset structures, taking a hands-on approach that extends into distribution partnerships and long-term scaling strategy. He's also advised over 200 entrepreneurs navigating one of the most competitive and often misunderstood categories in the consumer. Today, we're going to unpack what really drives success in beverage, how capital strategy has shifted, where founders go wrong when raising money, and what it actually takes to build a brand that survives beyond the hype. Welcome to the stage, Mike.
Thank you. Glad to be here.
I have been looking forward to this interview for quite some time. It's not that often that we meet an investor in what I would consider to be a very sexy industry, but maybe quite misunderstood. So why don't you just kind of start us with a bit of a journey in terms of what was your journey into venture? How did you come to doing what you're doing now?
Sure. So more years ago than I care to admit, I started my career in business development in like a boiler room kind of environment. Truthfully, I took that position because of the training. It's as aggressive as it gets. But that kind of led me down this journey of really being focused on revenue, but also focused on culture and influence and the things that kind of drive the awareness and we kind of refer to as virality inside of my companies, but the things that kind of give your brand or your company gravity to the consumer. So those were all things that were important to me. Spent again early on, just driving revenue for other companies before I got into my own sort of entrepreneurial journey. My first company was not super successful, but what it did teach us was not to do. And we turned that into more of a consulting kind of company to help other entrepreneurs avoid doing the things wrong that we did and help them, raise capital and form their business plans, figure out how to make the thing that they're trying to make and get it to market, commercialize it, hire, fire, train people, sales teams, fill out their leadership teams. And, it's been a bit of a sprint ever since then. So back in like the mid-teens, we kind of grew that company into more of a management consulting kind of company. Mm-hmm. So moving out of the, early stage startups and into larger companies. And that took us into an investment bank, which was another, very interesting set of experiences. But my group, again, was just focused on revenue and business growth at the time. And for really a myriad of somewhat random reasons, the investment bank had a lot of beverage alcohol exposure. Myself and my partner at the time, we both were already kind of waist deep in beverage alcohol, sort of ancillary like drink mixers and that kind of stuff. So we found ourselves working kind of hand in hand with the capital raise teams at the investment bank to help, grow these businesses. And we found ourselves in the boardroom, sitting across the table from a family office or at least their, representatives. And then on our side of the table, the brand that, the investment bank was working with. And at the time, it just felt a lot like the two sides of the table didn't know how to talk to each other. So, the folks didn't understand how family offices think. The family offices weren't willing to devote internal resources towards figuring out beverage alcohol as a category. Perhaps they came from oil and now they were kind of, branching out a bit. And so mostly for those reasons, the family offices ended up just talking to us instead of folks that are actually raising capital. So, in a very rudimentary way, that's how 99 Proof got its start, just making marriages happen inside of the investment bank, and kind of helping the investors understand how this category performs, why valuations are what they are, or, the methodologies behind them, is it supportable, and how do you get your money back? And on the brand side, the smaller companies, how do you speak to these people? How do you make deal make sense to them? And so moving forward from there, we grew a pretty decent size Rolodex of investors that are venture investors that are looking at or open to looking at deals in our sector. It's a very fun, experiential sector. It still has that, belly up to the bar kind of feel to it. The companies within it are telling their stories. You can still go into your neighborhood bar and, tell your story to the bartender, and they'll tell you all about the brand, the tequila you're drinking, where it's from, the type of terroir, if it's a wine, and all that stuff. So it's just a very cool kind of cross section of makers and consumers, and then on the maker side, there's this maker pride. They're very, very willing to sit down and tell you about the company they're building or the stuff that they're making, like what's on the inside of the glass. And so it's just all very cool. It's it's the type of industry that once it gets you, it pulls you in deeper and deeper. I'd be remiss if I didn't say that, the folks that are trying to grow the small businesses in our sector, that is a rugged, heavy lift. So it has its troublesome moments. But there's a playbook, there's tons of folks that are here that want to help. And so it's a nice little niche that we're playing in.
I completely agree. As you know, we own a number of alcohol-related businesses. So help me kind of unpack some of the things that you said. On one hand, you were saying that you were looking for businesses that can achieve virality. So how do you determine what emerging brands will achieve virality? And the second component there is how do these businesses, how should they think about competing against the super majors, like the Constellation brands of the world, that publicly traded company with thousands of brands and seemingly unlimited marketing resources?
Yeah. I'm gonna unpack the last piece first.
Okay.
There is definitely this stigma about competition in our segment. And anybody that's been paying attention to the press will know that, over the last 24 to 36 months, there's been a big market reset across most categories within beverage alcohol. Some people, depending on who you talk to, some people will tell you that was a rationalization. Things were going too fast, too wild, too many companies, too many brands. Then, there was need for, others will give you other stories, about supply side and, logistical challenges, over ordering. And, there's a bunch of different stuff that we can dive into. But the long and short of it is, the competitive piece, it is very competitive. You as a small brand, as a craft distiller, if you will, you are competing against the big guys, but you're also competing against the other U's, and there's a lot of other U's too. So, again, it's very important to be extremely clear-eyed when you come into this industry about what the SWOT looks like, what the competitive set looks like. depending on the category, there's probably too many entrants in the category. If you just walk into a liquor store, your average liquor store, it takes you like 30 minutes to decide what bourbon to pull. But on the other end of it, we don't want it to be a situation where you walk into the liquor store and it takes you 10 seconds to pull, right? You want you to be able to experience different things and try different things and get a sample of this and that. So there's a middle ground, that really does make sense here. In terms of competing with the big guys, there's this sort of underbelly and M&A in the sector where, that is the exit. So first off, the small companies, just for anybody that's not really familiar, small companies sell to the big companies, same everywhere, right? So, the strategics in our sector are going to look for those small brands, medium-sized brands that have kind of cut through that, very competitive, thin water type environment, and pick the ones that seem to have the right type of following, the right type of messaging that fit into their portfolio, obviously, that are achieving some version of exciting growth metrics, and seem to have a very good understanding of who they are, why they're there, and who their customer is. And over time, it's really been the craft producers that have been the innovators in this sector, right? So the big guys mostly wait for them to
innovate
good enough to poke through, and then they grab them. That's what the venture space looks like in this segment. So it's not necessarily trying to compete directly with, if you're a tequila, like competing with Casamigos, which is, huge, or Patrón, or any of the, like historical, like generational brands, Herradura, and, those types of companies that have been around for, an eon. What they're trying to do is carve out a more specific niche that's more in line with who they think they are. And we see that happening much more competitively, across the category with the smaller companies. Once you get big enough to be in the Patrón category, you're really not competing with G4 or, some of these new, or relatively speaking, newer companies that are craft and kind of champions of the small company thing, right? And so some, depending on how deep you go into the sector, bourbon guys, tequila guys as well, will give you some version of like a quality argument as well, where these like craft players are paying very close attention to grain to glass, and they have the ability to do so because they're not doing these massive runs and that kind of stuff. So that's another real important, like depending on the category, important feature set is this no additives, and if it's in tequila, or grain to glass if it's in bourbon, this persona that the company takes on, that it's extremely high quality, small batch, kind of akin artisanal. Yeah. It's akin to like making it in your own kitchen with high quality only ingredients, that kind of stuff. And that resonates in our sector, in our market. People want this high quality, not overproduced kind of product. So, that's the playbook. That's what people are using today, in order to differentiate themselves from really anybody else. From there, you get into authenticity that does kind of dovetail into the product itself, but also authenticity and the brand messaging strategies. There's a lot of tombstones in our sector where, the brand leadership got a celebrity involved. It wasn't an organic partnership. Perhaps the celebrity didn't even drink, or at least they didn't drink that. And somehow, the powers that be thought that would be a smart partnership.
A good idea. Yeah.
Yeah. And the consumer today can see right through that. There's always this like, do we really need another celebrity brand kind of situation? But the simple fact is, if it's very organic, then it can work. You've got to be able to attract attention to your company. And if that's something that your company, has in its repertoire, if it resonates specifically with the a high influence celebrity or influencer, then, that playbook's been written. You can do it. It's there. As long as authenticity is there, then it's a smart move. And if you can get enough effort, let's call it, out of that partnership, then you can get a lot of eyeballs on your product. And if the product can pass muster, then, you get repeat sales. So, that's definitely one way to get it done. It's not the way to get it done. It is a way. There's also part of this reset that's happened over the last several years that has kind of taken early mid-stage Bev Alc further away from this comparison that we used to make to early stage tech startups, which was like all spend and no revenue. That was maybe late teens, early 2020s was kind of the death of that in our sector. It used to be possible to expand from, a very few number of states where your product is distributed to like 30 or 40 almost overnight. And just throw money at it, cash-incinerator style marketing, dumping money into marketing and creating, massive awareness. But it's very expensive. And, over the last couple of years, investors have been much more careful about trying to invest into profitable companies or companies that have very clear line of sight into their point of profitability and to become EBITDA positive. And so that's another trend. If people are thinking of getting into this category or are into this category and they're, listening to me drone on and searching for something about how they run their company, that efficiency with your capital is front and center with investors now. It's certainly front and center with strategics who are seeking to extract as much enterprise value out of their acquisition as possible. And so that like cash incinerator style marketing budget, that's toast now.
So based on that, Mike, are you seeing a bit more emergence of RTDs or products that are easier to bring to market, like vodkas and gins versus like bourbon, something that you have to age, or tequila, something you have to age, or wine that it would take you easily 2, 3, 4 years before you have like your inventory available for sale?
Yeah. So, again, this kind of gets into like a complex topic, but so first off, there are a lot of entrants in lots of those categories. Certainly there's a larger moat around the aged spirits. So bourbon, tequila, there's some aging of gin. Vodka is pretty fast to make. Most gins, relatively speaking, fast to make. There's a lot of raw ingredient stuff that, that has to happen on the gin side, but nonetheless, and then kind of going further, wine definitely akin to the more akin to the aging process or timelines. But you get into the RTDs, that those are almost no moat around them, right? And so you're really you're looking at how do we establish a brand? Like what is this company all about? Because there's a million vodka sodas, a million tequila sodas that are out there. So it's got, there's got to be something.
What's different about the one you have?
Exactly. And I'll tell you, like if you're about to launch one and you can't answer that question, it's going to be very difficult for you when you're in a cold case, and there's just rows of tequila sodas, right? So there's got to be something different about it that the consumer wants, not, just what you think is important. But you raise an interesting point that, the aged spirits, those, this kind of got into some of the downturn over the last couple of years, but by and large, those are appreciating assets. And so those companies, if you can find lenders or investors that, can view your inventory as an asset, you can unlock some capital there to help you get from this dry period where there's no revenue possible because you have to age your product. There's also, sourcing where companies are buying aged product from somebody else and then, putting their label on it. And that happens in really in all spirits.
It's interesting. I mean, we primarily specialize on the wine side. What we're finding is that the market that previously existed on primeur, like buying Bordeaux or Burgundy's futures, that has kind of disappeared. Because for us at the moment, it's a lower risk, and in some cases, lower prices for us to buy back vintages and library releases than it is to buy futures.
Yeah, absolutely. We saw that a lot in bourbon, maybe most often in bourbon.
Mm-hmm.
A couple of years ago, you're looking at like $1,000-$1,200 for a new barrel of bourbon. Depending, maybe if you're at a distillery, you can get a little south of that. And, you age it for, 3-4 years and start selling it to the companies that can actually use it. And, you make a nice tidy profit, 2-3x sometimes. Right.
Yep.
But that market bottomed, and so now that same $1,000 input cost is like down in the like 600 or a little lower than that. Right. So, all of the age statements, that those barrels appreciate annually. So all the age statements, all those prices are south of where they were, sort of at their peak, heading into this downturn, like right post COVID. And so, people got upside down there and started trying to liquidate. That's still happening. Still people are trying to figure out what to do with their aging inventory. I think pricing ends up coming back on that. You mentioned Bordeaux. I think it's cyclical, and there's a lot of short-term thinking that happens in our industry and in many. And so, when you see articles come out that say, like, is this the end of the bourbon boom or whatever? There's just no depth to that at all. And, it ignores entirely the fact that this is a commodities heavy sector, and that type of investment, that type of entity, that thing runs in cycles. It peaks, it valleys, it's always moving. It's similar to our stock market. It's moving like this, but we see valuation work that looks like peaks and valleys. And so this is simply that. I think you hang around long enough, you'll see more exciting growth, depending on who you're reading right now. They're still saying somewhere in the 1.5 to almost 3% growth rate is expected across Bev Alc this year. I would be lying to you if I told you I was confident giving you my number. It's been so up and down the last couple of years, but certainly growth this year. I think if we could solve like some of the inflation issues at the consumer level, I think we'd see some more predictable numbers at retail, which our industry is very reliant on, both at the restaurant and bar level, and then at the liquor store level. So when the belt gets tightened at home, we feel that
for sure. And we're seeing this here in Canada as well. The one thing that's really negatively impacting the industry, obviously we talk about the GLP-1 drugs and what's the impact on them, and that 10% of the population is already on them, and as a stimulant or appetite suppressant or urge suppressant. Food inflation is probably our biggest counteracting force, because in some cases, food has gone up as much as 10 to 15% up, particularly chicken and beef. In some cases, it has gone down, but on average, we're seeing a massive increase in food inflation. The other trend that's actually in favor of the alcohol industry that we're seeing is the continuous increase in desire of the consumer for analog events. People are just so fed up of being lonely, so fed up of digital events. They want to be out surrounded by people. Like, I think we talked about it last time. One of my favorite podcasters is Scott Galloway, and his favorite saying is that drunkenness is togetherness. So if you're out for an event, what do? You drink water? I love liquid that, but is that what you're going to drink the entire time? Yeah.
Yeah, absolutely. I think one of my favorite things about this industry is there's like literally something for everybody, right?
Mm-hmm.
If you are 100% sober or even like sober curious. There's 50-50 cocktails that are out there. There's alcohol-free cocktails that are out there. There's, you know, if you like bourbon or, you know, you want to drink it neat, whatever the type of spirit is, there's that. But there's a whole class of very talented mixologists and bartenders, you know, professional and at home, that are capable of producing like really fun things to try. It's very similar to food, to your mention, where, you know, you can go nuts with food, right? I mean, if you really want to dig in, you can at home produce Boeuf Bourguignon. If you want to go that route, you know, you can wow your friends. Same thing with your bar program, whether it's at home or if you are a bar, you know, it is a great time to be you on either end of that. So, you know, the entertaining piece is a great add-on to, you know, having a party. Some still are having parties around the entrance in this category. You know, it's like the primary reason for the get together. Similar to, you know, food, like having a barbecue. Like a lot of times the beer is just as important as the barbecue is. So, you know, that I don't think ever changes in this industry. It's been like that as almost as long as the industry has been around. This occasionality for drinking is an often discussed topic. It's one of the ways that brands also can differentiate, is, you know, to own an occasion or occasionality. And, you know, it's fun. At the end of the day, people want to have fun. It doesn't matter if you're an introvert or an extrovert. So
I agree.
Yeah.
And if you're an introvert, a little bit of liquid courage helps in getting the conversations going.
Yeah, exactly. So, so yeah, you know, I think, you know, for sure, regardless of the, you know, revenue cycles or, you know, production difficulties, production ease, logistical challenges, logistical ease, I don't think that the experiential nature of this business changes much as it goes forward. I think that, you know, if anything, people will continue to get creative about, you know, how they're delivering products to the market. It's a great example. A great example of this, I think, to me is in the wine sector. So kind of touching on one of your passions. So there's new delivery of the liquid itself over the same, you know, 3-4 year period, where, you know, high quality wines are being delivered to the consumer in boxes and cans instead of in glass. You know, there's a lot, the average consumer doesn't really know this, but there's a lot of thought that has to go into that first as a product line. So if you're delivering red wine to a consumer in an aluminum can, you know, it often takes a special liner. So the wine doesn't pick up aluminum. Oftentimes part of the age statement of the wine includes what happens to the wine when it's in glass, which is often why you'll see red wine in tinted glass. And so, you know, a lot of times red wine that's delivered to a consumer in an aluminum can is going to taste younger, right? So you need to know. You
don't have the micro oxygenation.
Absolutely. And so, but on the other end of it, you know, touching on occasionality, the average consumer is very health conscious and very quality conscious, right? So they want to drink something that's high quality. Thus, you know, a lot of the prices per drink have kind of gone up recently. And we can touch on that, but also the occasionality of having a glass of wine per night instead of a bottle or half a bottle. For me, maybe I want to have half a bottle tonight. That's great. That sounds like fun. But, you know, for some, that's going to be too much. You know, they want just one glass of wine. And so, you know, the cans are a really interesting entrant where, you know, a single person who is just going to have one glass of wine tonight when he or she is, you know, having their dinner, they want that accompaniment, but then they want to go to bed, they want to hang over, they want to deal with anything else. So, you know, one glass of wine out of a bottle of wine, you know, you're looking at 4 days on average if you're a regular pourer, and some people are pouring light. So maybe 5 days, you know, the thesis is maybe that wine, you know, starts to not taste as great. Or if it's champagne, then forget it. There's no bubbles left by the end of that. So, the entrance of some of these smaller.
But there's a way, Mike. There's a way to combat this. Like we represent a repour. It's a bottle stopper with oxygen absorbing molecules. So you put the repour, it keeps the wine fresh for weeks and months. You can have Corvin and you can have sparkling enclosures. You can have a flat like still wine enclosures. Now. Not very many people would have this, so maybe they kind of resort to vacuum pumps, which is not really good. But there's options for people that want to be wine curious or that would not spoil the wine. Because I personally don't drink much, but I love to have a glass of wine, and if I want to have a glass of wine, like I want the wine to match my mood. So if I feel like something big and bold, I want to have a glass of Barolo. I don't want to have the full bottle. My wife doesn't drink, so for me, it's like, okay, I'm just going to open up a bottle. Doesn't really matter. I'm just going to close it, and I know it's good. Yeah.
Yeah, and so you're going right down my lane here. There's a bunch of new tech. There's a bunch of new products. Well beyond just the way that the liquid is delivered, to the person's mouth, and I love that you mentioned, new types of stoppers. Like there's new types of openers, there's new types of stoppers. Right? And honestly, like if you're a wine drinker, you should probably invest, decently into one of those, or a flight of them, if you will, versus just the little rubber stopper that you like. Right. So, those you often get them like on for champagne, like a if you buy a nice enough bottle, it'll come with the bottle topper, and they're mostly just medium. They're mostly mediocre. But there's a bunch of room for those kinds of products now because of how people are enjoying those types of liquids. And
what I have in my hand is, I don't know if you can see it. The company sent it to me. It's very popular in Europe. It's called Pultex, and it's antioxidation carbon filter. So there's plenty of products out there for people that want to be wine curious or alcohol curious. Like there's no excuse. And the repour comes to about $1. I think a repour, you can use it for the entire bottle. There's no lifespan limitation. You can use it for 3 weeks. 3 to 4 months, because essentially it's kind of like those packets that you find in suitcases or a product. It just absorbs the oxygen. So if anything, the wine becomes reductive. So you have to open it to let it breathe, absorb some of the oxygen back.
Yeah, absolutely. I mean, there's a product depending on what your occasion is, what kind of person you are.
Yeah.
There's a product for you that you will brutalize. You will use it, every day. Now, in today's, there's what somebody just sent me it's sort of like a Yeti for wine, and it's got a cup on each side. So you just bring that and you've got, your picnic. So, there's something for everybody right now in this industry. And, it's an exciting time. Like, I'll touch on some of the, some of the negative stuff, because I mentioned it several times. So I feel like we should at least tell your viewers a little bit about how people are looking at it. So, the industry had several resettable moments, let's call them events, happening in concert all at the same time. So the result of it, starting from the most recent and moving backwards, the result is that for the first time in the last decade, PE in our group has gone down over the last year. So private equity investment in this sector was lower last year than it was any of the years before. Over the last decade, it's always gone up. And it's a result of one, some of the things we've touched on, but really coming out of COVID, what happened was this massive restocking that sort of choked the logistical, the entire supply side of beverage alcohol. So, in your mind's eye, if you'll think back to what was happening during COVID, 50% of the revenue chain for an average spirit, or it doesn't matter, alcohol company, 50% of that disappeared because bars and restaurants were shut down.
Yeah.
So you had only online, which was in its infancy at the time. You had direct delivery like Drizzly, which was on fumes going into COVID. And you had retail. But most people weren't going to retail stores, at least a little bit of that kind of took a hit. But then, as things started opening up again, you felt more confident, at least with a mask on, you could go into a retail store and buy stuff. So what happened here was people were making their like monthly liquor run every week. So there was a lot because people were miserable. And again, like mostly people want to party, right? Like people were outside, in our neighborhood, outside on their driveways where you could be outside and far enough away from somebody where you wouldn't
social this. Yeah.
Yep. But you were outside with a bottle of wine or a bottle of something or, a few beers. And we were doing that like every single night. So, because we were, nobody wanted to be in their house anymore. So moving forward, when the other 50% of the revenue chain opened back up, bars, restaurants, distributors, the whole middle tier in the U.S. beverage alcohol sector, everybody was restocking. Like most of the warehouses were empty. All the bars and restaurants were empty. Some of the retail was empty, and suppliers turned the machines on full blast. Right. So then all of these orders hit the warehouses at the distributor. They mostly went all out the door to retail and to bars and restaurants. They had a restocking event in the middle tier. And then now you've got to rely on consumers to buy stuff, right? To clear the shelves or to open up space at the bar and restaurant. And when you pair that with inflation and the declining, restaurant spend that was happening at the time, like most people weren't really going back to bars and restaurants yet. You saw there was this period of time where a lot of bars and restaurants were going out of business after they had been reopened. That period of time is kind of what I'm referencing here, where the whole system got choked. So it takes time to recover from that, and a lot of businesses in our sector were struggling with their finances. They were trying to raise money then all at the same time. So it became very polluted as far as the capital raise segment. There was just everybody. It still feels like that now. Everybody's raising money, big companies, small companies. So it all sort of contributed to this contraction running in parallel with that was this scenario I mentioned earlier where a bunch of, folks like me, our colleagues, I guess I would call them, came in and bought up a bunch of bourbon barrels and had been aging them. And it was a great move, right? Appreciating asset, similar in wine, right? That definitely happened there. It's been happening for a long time there. And it started getting to the age statement, like producer return timeline. And they had to lower the prices in order to move it because there wasn't enough need for that amount of liquid because of all the contraction that, has been previously mentioned. So all of those things happened all at once. Any one of them happens at any one point in time, fine.
No big deal.
But it happened all at the same time. And so we saw a negative growth in this industry, which really doesn't really happen. It's grown, for decades at like 3% annual growth rate. And so, everybody approached it like the sky is falling and this is the end of is alcohol over? There was actually like some of those articles that came out, like, is the alcohol industry dead? Like, no, it's not dead. It contracted, so have some patience and deal with it. So, and that's where we're at. So, we're coming out of that. It's a great time to be an investor in this sector. There are great companies in this sector that now have normal valuations and they have a very clear path to EBITDA positivity, or, the ones that are a little larger have a very clear path to exit. The quality of the teams that are running them is superb across the board. There's not a lot of founders out there that even the first time founders that we're seeing, currently have a very high acumen where they're not like learning on the fly as the, as the parachute is
trying to
hopefully
figure it out. Yeah.
Right. So, that used to be way more common when it was very easy to raise capital. We saw a lot of founders that were first time founders and, we're just figuring it out on the fly. And, you had to, as an investor, you had to figure out how do you, maybe some of them can be successful, but, mostly they're not, or they're not ready to receive, institutional capital. And so, again, in this industry, it's a good time to be an investor right now.
What are you seeing in terms of valuations, price to earnings ratios? Kind of like, well, like, and I'm not asking you to generalize, but if because obviously that will be top of mind for our listeners and viewers, kind of like, well, what's my business worth?
Yeah. So, remembering that the companies that we're looking at that are pre-exit, most of them in our sector are going to be in the red. There are very few of them get to that EBITDA positivity until like a very short period of time before there's some kind of an exit, right? So disclosing that, right? So normal valuation work doesn't work, right? Like if you're
can't do this,
no. So it's always historically been done on revenue multiples or some type of case volume math, which differs depending on which strategic you're talking to. Some will, let me give a little bit of a backdrop. So, prior to this reset, we would see double-digit revenue multiples as valuation, right? So you're a $1 million company and you're trying to provide a, supporting documentation for a $10 million valuation, right? 10 to 1. Or maybe even more than that, right? Like we saw plenty of $20, $25 million valuations for a, $500,000 company. So on revenue. So, you get to a point where you can't support that. And the reason is mostly because they're very early. They've gotten some kind of, it always kind of goes like, so they get to that first thing and they're like, wow, we're exploding, but it's just, it's just a small explosion, right? So
the curve doesn't stay on an incline, right? Yeah.
Right. So, that makes me answering your question. It makes it a little more difficult to do that. Now we're seeing something more like a 6x revenue multiple. Earlier on, it's more mentally, it's more like just get the money. Don't try and be this, enormous valuation today. Prove valuation by your results. And at the beginning, just do what it takes to get the money. And so, there's not, I'm not telling you to give your valuation away, but this, 12x revenue multiple, 15x revenue multiple, and it's almost always supported by these salacious exits that have happened, historically. And there's a key point that's been forgotten in an argument is that you're not that company right now. You're a $500,000 company. You're not selling $50 million worth of product today. You're selling less than one. So you can't prove that valuation. Anybody that's, that looks at deals commonly is going to, blast right through that. So, So, on exit, we're seeing also kind of the same thesis, right? Sub 10x revenue multiple. And mostly the strategics will find differing ways, right? But some way to cap that revenue multiple to get it back down from a thesis 10x down to like a thesis 7x revenue multiple. They'll take marketing out of it or, a bunch of different, ways that they have to value it. But that's roughly what we're looking at is somewhere between 5 and 8x on average revenue multiples.
And
And
that's consistent with what when we do private company valuation, that like we pull information from a whole multitude of sources like Crunchbase and PitchBook and Capital IQ and Muse public sources. And so our observation from 2025 to 2026, the valuations on revenue, the multiples on revenue went from 7.3 to about 6.2. It's kind of based on the multitude of sources. Now we're averaging, and some companies are bigger and some are smaller, so there's some of them have more of a higher quality of earnings. So that aside, this is kind of what we're seeing in terms of the general trend. So that jives really well with what you're saying.
Yeah, I agree, and we always attribute it to the founder mentality. It's a soft point that is pretty hard to mine when you're when you're doing diligence. But everybody thinks that their baby is the best baby, cutest baby, shiniest. This is my shiniest object in the industry. Yeah,
of course.
Yeah. So and we see that kind of proliferate in the valuation conversation, right? So it's important to level set expectations when you're early on in these conversations. Again, I'm not telling founders to go out there and just, dribble in with a 1x revenue multiple, or 1.2x revenue multiple. Like that's a great value for an investor, but,
of course.
you need to know where you are and have a very, very clear, highly executable roadmap to get to, if you want to be a 10x multiple. Okay. Like show me the plan.
So let's double click on this, because we never answered the first questions around virality. I mean, obviously, in order to get to 10x versus 2x, like you have to have something that has that gravitas that pulls people into the brand. The brand has sticking power. The brand has relevance in the consumer mind. So tell me a little bit more, kind of like, what are you looking for when you're looking for virality?
Yeah, we're looking for a bunch of inside baseball, really. We're looking for ROAS, your return on your ad spend. If you're overweight, if you're buying market share, it's when we get into the financials, it's going to be obvious, and if that's the case, really only a strategic is going to be able to help there, right? That has just a ton of capital, unless you can increase your influence and keep your ad spend at least flat there, or lower it, right? So you dilute it, so it's not as expensive to reach the same or a larger number of people. There's a bunch of different metrics that different firms use to calculate on a per case basis, or however you want to chop that up. But nonetheless, we look at it. And outside of that, so there are definitely a somewhat statistically significant number of companies that are able to just take the ground and pound approach, small first, own your backyard kind of mentality, and prove that they are a quality product that people want. Prove that their messaging is quality and people respond to it, right? In these smaller, less expensive kind of ways. And when they expand from there, they expand in a way that's rationalized too. And so, it's important for people to understand.
Sustainable, scalable,
yeah, exactly, right? So if you're, again, because this is a high touch kind of sales engagement for the most part, whether it's digital, or whether it's in person, there's still a lot of touching that has to happen here. Plus, it's a taste and feel, environment. So for those people that are in expansion mode and they're looking at expanding from like Texas, which is a massive market, and there's just a bunch of products that are new that come to Texas. First, so I'm just going to use it as an example. But if you're in Texas and then you expand to California, that's very difficult to support as a small brand. One, it's a very disparate geography, right? So if you're based in Dallas, it's very, very far away to get to California. It's closer to drive from El Paso, the western tip of Texas. It's closer to drive from there to California than it is to drive across Texas. So it's very difficult to be efficient with your capital if that's the plan. And everybody has, dollar signs in their eyes when they look at these, big states to expand to. Instead, what might make sense is the contiguous states around the state that you're in, or just something else besides spreading yourself all over hell and trying to support that. So, that's one way to ensure on the virality piece, getting back to being efficient. You have to be efficient with your messaging, efficient with your capital. And it's very difficult to message enough times those two very disparate, very big audiences. So, what we see, giving an example without, dropping names and stuff, but one of the companies in our portfolio is in a very small number of states, except for one strategic partnership, really, with a very big retail organization. And they very much over like 10, 11 years now, have been a champion of their, it's evolved several times, but they're the champion of their own messaging, right? They're not relying on other people to shout that for them. They don't have a celebrity. They're not doing any of that stuff. It's them. It's who the brand is. And that resonates with people. It's a laid back.
It's authentic.
It's authentic. Exactly. And so, again, kind of touching on the, how do you be a viral brand in this space? Authenticity is key, and it's hard to replicate, because there's so many opportunities that come through the door for a brand on an average day. Right. But this brand, down to the type of charities that they support, everything contributes to the same kind of messaging statements that they're making about who they are and why they exist. And, in this sector, definitely with the younger consumers, they want to feel like they're making a difference. They want to feel like they know the companies that they're, buying, or that they're evangelizing in the best case scenario. So that, getting people comfortable enough with the brand, believing in the brand itself, the company itself, and they're out there saying, well, yeah, I drink this company. I whenever I'm drinking tequila, I'm drinking this. Or people go over to their house and they see the bottles, right? It's all the same bottle. So in a very winding way, like that's what virality looks like. The simple answer, of course, is to, attach a celebrity to it, and then their thing like goes viral, Kendall Jenner or whatever. But there's only a very small like handful of the Kendall Jenners or the George Clooney's or the Ryan Reynolds, right? And the next time that Ryan or George gets involved in a liquor brand, is it going to be as authentic, right? Because I thought you drank gin, dude. Now you're doing a tequila. I'm not saying that he is, but that kind of thing. Like, there's only so many rocket ships, so you have, as a company, you've got to be responsible for generating your own "who are we" ethos. And then, if there's a celebrity that, you can attach to it, great. That helps, that helps it go viral. It helps you get eyes on it. But if it's not a good message, if it's not something that's resonated, that you've already proven out, and like this language works, this is who we are at our core. And you can look at my LinkedIn, you can go talk to people that know me, and they'll tell you that's who I am. Like, if it's not that authentic, once it goes more broad, it's dead.
Yeah. What about, some people are a lot more comfortable in front of cameras. For some people, it comes easy to be authentic, to be on brand, to drive this message, When we're meeting with hospitality, food businesses, or liquor brands, one of the common things that we get is like, well, I'm a small business, I don't have the resources, or like, I do everything. Like, so how should they think about what should they keep in-house versus what should they give up and outsource or delegate away?
Yeah, that's going to be different for
everyone.
Most of the companies. But if I could be man, as general as possible, as general as I can. I would, my nickel's worth of like Mike advice here is to focus on who you are. You, the human being, leadership team also, but who you are as a company. So I'll give you an example. If you're a high quality, like luxury or prestige category, tequila, if you bring things to the market that don't fit in with that messaging, then you are working against yourself. In defining that, you need to know like what's the size of that category, right? How am I going to make enough money to be interesting, or make enough damage, or do enough damage rather, make enough impact in order to get where I want it to go. And if those two things are out of alignment before you even penetrate the market, you have to fix that. 100%. I'm keeping that in house. If I hire a marketing firm to generate that for me, already not authentic. Right?
Well, and it is all the data, the report is published by the marketing research. You have to constantly stay on the market to understand it.
Sure, but if it's out of alignment with who you are as a company and the kind of company that you want to be, then today's consumer cuts right through that. It used to not matter, right? Jack and Coke when we were in college, like I didn't care. I don't know Jack, right?
Yeah.
I don't care. Now they want to know where the farm is, where the wheat comes from, where they're making the bourbon, right? Like, it's
how is it made? What's in it? Yeah.
Exactly. So if you're bringing a 10-year bourbon, they want to know that it was yours for 10 years.
For sure.
And if it wasn't, if you're buying it, then they want to know where that was from and the story there. So again, like if you're going to be a sourced brand that's sourcing, liquid from wherever, you're going to have to concoct your way of telling the market that this is who we are and why we're doing business the way that we're doing, the things that we believe in, all that stuff in-house, 100% in-house.
Okay.
You can hire a marketing firm to help you understand how to tell people that, but not to come up with that, right? So, on the production side, the sheer economics of starting a distillery, regardless of what kind of alcohol you're making, or a vineyard, or, even worse, right? The economics of beginning that are a full showstopper for most people. So I would say, this industry is very receptive to contract manufacturing, as long as it is in alignment with your messaging. So if you're a prestige product, you're sourcing very high quality stuff and buying it, probably at a premium. If you're in the mid tier where price is your game, you're going to compete on price, then you're going to sacrifice on some of the quality items that are going into your can, bottle, whatever.
For sure.
And if you're in the low tier pricing point, then you're looking to be a well, or you're going to package your stuff in plastic or whatever. But then don't charge $150 for that jug of whatever it is, right? Because the consumer's not going to do that. So, again, all of that is in-house. The production, sure, out of house, as long as it's in alignment. I love the
warehousing, distribution. Push it out.
For sure. I would own also internally a large degree of your sales efforts from a strategy, messaging standpoint. Again, like in the early stages, like people have to use brokers. A lot of times they've got to rely on the distributor to pull weight somewhere. They've got to, maybe share resources with another brand. So you have like a shared sales rep kind of situation. So you're giving up control somewhere, but how they say, what they leave behind, all that stuff. Again, it has to be true to who you are. And so you need to own that process of it and so on. So,
and I mean, you said it, it's a very high touch business. It's a very relationship based business. And so without that, people treat your product as a commodity unless you have some kind of a marketing messaging and a very well established brand that just sells itself.
Right. Yeah. As many of the relationships that you can bring in-house, at the end of the day, once you kind of start getting into new states and trying to get into bigger accounts and so on,
Yeah.
you know, that can really become part of your IP.
Mm-hmm.
You know, if you're like, some of the brokers are great at it, but others, you know, haven't figured out how to manage it when you like the sales broker has like 9 different tequilas that you're trying to sell into Target,
Same
you know,
accounts. Yeah.
or whatever, like Total Wine, like you're not, that has to be authentic too, right? So
100%.
each time the guy walks into the store, like, you can't tell the buyer this is the best tequila, because he's going to say, well,
What do we get it?
yeah, there's 8 other tequilas you sold
Yeah.
me. So, you know, again, authenticity. It's, I mean, it's true. I would argue in all the sales roles I've ever had, all the business development, all the leadership roles I've ever had, if you're in it for, you know, not the right reason, it comes across. If you're talking to this person for, and saying things that are, you know, borderline untrue about who your company is, and, you know, why people are gravitating to it or not gravitating to it. Like, you've got to have all that figured out inside, you know, before you bring on a sales team, you know, to try and selling with that kind of messaging in environments. And it's not going to work. I've had that, you know, personally. It's just,
I believe it.
It's brutal.
So Mike, I know that by time, you talked about focusing on sustainability, focus on running a good business, being authentic. Any other parting thoughts and comments?
Yeah. So it's important for people, even the ones that are in it and already know this. I think it's important just to hear it. You know, on the investor side, we know this is a grind. It's a grind in our industry. It's a grind in many industries. You know, to grow small businesses is difficult. Give yourself the space and time to be okay with that, and to not give up, and, you know, the confidence to not give up. And, you know, I find that when you're okay with that, when you can get right with that, you can get in the room and whiteboard out a solution for many of the problems that you're against. They're not necessarily a full-on showstopper until it's quite obviously time to stop the show, right? So, you know, my advice is to not just take it on the chin, you know, to maintain a positive attitude. Your people are watching you, you know, so maintain that positive attitude, and use that in your leadership style, and be okay with it. Be in a grind. We're all grinding, you know. My job's a grind too. You know, there are days that are terrible. So, you know, we can all identify with what you're going through, and hopefully, you know, doing those things that I just mentioned will help you have many more sunny days than rainy ones.
That's awesome, Mike. Really appreciate your time and insights. That's been fantastic conversation. In the show notes, we'll put where people can find you, where people can follow your work, and keep doing what you're doing, because you're definitely helping the industry thrive.
Well, thanks, man. Well, I enjoy being here, and you know, it's been great to get to know you, and hopefully we can talk again.
For sure.